Over my almost 30 years in the financial services industry, I have seen investing transform the financial lives of so many individuals and families. But if you don't know where to start, I've got you covered. This is Investing Basics, the second episode in our series, Finance Uncomplicated. Let's dive into it. Over the last 30 years, I have talked to a lot of individuals who want to invest, but they tell me they just don't know where to begin. Today, we are going to answer that question. My name is Will Allen. This is the second episode in a series called Finance Uncomplicated. The first episode was on budgeting, and I would encourage you to watch that video if you haven't before, because that's a critical piece that allows us to grow today. So, by the end of this presentation, we are going to help you know why investing is essential for your financial future, how to choose the right investment vehicles, a step-by-step action plan to start today, and very importantly, common investment mistakes you want to avoid. All right, let's start off by looking at why you should invest. The first reason is something that has been in the news a lot over the last 5 years, and that is to beat inflation. We all know that prices today are much higher than they were 4 or 5 years ago. And that can really eat away at your money. And as you'll see right here, every minute that it is in a checking account or under a mattress, for you who are old school, you are basically losing money. In fact, if you take a look at over time, $1,000, and let's say there was an inflation rate of 3%, 5 years later, that $1,000 is basically worth $860. 10 years later, $740. And 20 years later, $550. That means basically half of the value of your dollar has been erased as a result of inflation. So in order to keep up with inflation or do better, investing is the solution there. Now, the next thing we want to mention is talking about the power of starting early. Listen, I've talked to a lot of people who have said, listen, I want to invest, but right now is not the best time. I have some expenses coming up. Maybe it's in their 20s when they're getting out of college, they have some debt there. Early on, they get married, they're needing to get a new house, then they have kids. That's a reason they can't invest. Next thing you know, you're in your mid-40s and you haven't started yet. Now, reason number 2 to invest is to build wealth through compound growth. We'll talk a little bit about compound growth later on, but the fact is, over long periods of time, if you want your wealth to grow, investing is the best way to get there. Then, number 3, to achieve financial independence. Look, everyone wants to have later on in their life freedom to do what they want to do at that time. And in order to do that, you have to have the financial resources. The point at the bottom says, remember, not investing is actually a decision to lose money slowly through inflation. When it's put that way, it changes the game for a lot of people. Now, let's take a look at what impact starting early has on the ultimate outcome. And we're going to take a look at 2 people, Sarah and Mike. Sarah, she begins investing at age 22 and starts saving $200 a month. Now, most people, as they get older, they make a better income and they start saving more. But just for ease of comparison, we're going to say that she keeps saving just $200 a month, and she does this for 40 years until she is of the age of 62. She has earned 8% per year on average. The market itself It's averaged about 10% over long periods of time. We bring that down a little bit. And so she invests $96,000. At age 62, she has, as you can see there, $698,000. We'll round that up to $700,000. So that is a good number. Now let's look at Mike. Mike waited an extra 10 years to age 32. A lot of people are in this camp. He starts saving then, saves $200 a month also for 30 years until age 62. So he invested $72,000. That's $24,000 less than Sarah. He also earned 8%. At the end of the day here, when I ask folks, when I do this class with individuals there, oftentimes they think, hey, it's probably pretty close, the two, what they have at the end. But no, if you take a look at Mike, he is at $298,000. Let's round that up to $300,000. So a massive difference, $700,000 versus $300,000, despite the fact the only difference was Sarah started 10 years earlier. So look, no matter what your age is now, the key takeaway is investing today is far more valuable than waiting and kicking the can down the road. Next up, we are going to talk about investment types and risk and reward. See, the big thing when it comes to investing is figuring out where you stand as far as how much risk you can tolerate. In other words, when the market is moving up and down, how does that impact you? There's different investments depending on how you answer those questions. So the first one on the risk spectrum, the most conservative, we are talking about a savings account. And this is very, very low risk. These are great for emergency accounts and short-term goals. But on the flip side, the rate of return is going to be pretty low. Now, I want to differentiate here. There's the savings accounts that are at the big banks that pay near zero, and high yield savings accounts, which we talked about in our budgeting video. High yield savings accounts right now, and we're filming this in October of 2025, right now are paying around 3.5% and have no risk. So that is the most conservative investment. Next up, bonds. And here you're talking about a little bit of a step up in risk. You're going to have some movement. The average rate of return here is between 3 and 5%. And over the last 50 years, there was 1 year, 2022, when the bonds did very poorly, and you could have seen a decline of between 5 and 20%. Outside of that 1 year, the biggest decline has been less than 3%. So you're generally not going to see a lot of movement here, and you can count on over time 3, 4, 5% rates of return. Now we turn to stocks, and here I'm going to talk about index funds. In the stock market, there is something called the S&P 500, which is basically 500 of the biggest and most important companies in the U.S. And over the long run, this investment has averaged a return of around 9, 10, 11%, depending on when you're measuring it. Now, there is more volatility here. There have been some years where this has declined 30, 40%. We'll talk a little bit about that a little later. But nonetheless, this is a great way to kind of start your investments in the stock market if you are just learning. And it comes after bonds in terms of the risk spectrum. Next up, individual stocks. Listen, if you own the S&P 500, one of those index funds, you have virtually no chance of losing all of your investment. But if you buy an individual company, you can lose all of your investment. Now, if you buy Coca-Cola or Walmart, the risk of that very, very small. But if you buy much smaller, more speculative individual stocks, that risk does go up. But I tell individuals, especially if you're new to investing, start very small with individual stocks because there's a lot more volatility in those names, and that's not helpful when you are learning how to be an investor. Now, the last investment I have listed here is something that I didn't have in this presentation 5, 10 years ago, but I do now, and that is cryptocurrency. Most people have heard of Bitcoin. Ethereum is another cryptocurrency. These are even more volatile than stocks, or have been at least in the last 10 years. And what I say here is if you want to take a very small percentage of your investments and put in something like Bitcoin and follow it, that's okay. But if you want this to be 50, 75, or 100% of your money, that is very, very high risk, and I don't recommending that when you're beginning. The point is, for most investors, having a mix of these investments that I just covered is the way that you want to build your investment portfolio. Now we are going to talk about investment vehicles, i.e. where to invest and what kind of accounts. We're starting off with a 401k. This is if you work for a company and they have a 401k plan where you are able to save a percentage of your pay into this account, and the company will dictate what platform you have to use here. The pros here is that many companies have what they call a company match, meaning if you put in, say, 5% of your salary in here, they will match. Some companies very generous. They will match dollar for dollar. And if they do that, that is a phenomenal benefit for you. Others, it's more like 3 cents, 3% of every 5% of savings they'll match. But that's the first pro. The second pro is you get a tax advantage. When your money goes into your 401k, you don't have to pay income taxes on that at the time. Now, the money will grow over the course of your career, and when you start withdrawals in retirement, you will pay taxes at that time. And then the other nice thing is if you're doing this, it's automatic investing. You don't have to think about it. It automatically, each paycheck sum goes into your 401k and gets invested that way. Over on the cons section, you just need to be aware there are penalties for early withdrawal. If you're under the age of 59 and a half and you go to take money out, you are going to pay a 10% penalty. So just keep that in mind. The golden rule you see there, always contribute enough to at least get the match. It is free money, and if they're matching dollar for dollar, that's an instant 100% return before you even invest the money. All right, the next investment vehicle is IRAs, individual retirement account, and Roth IRAs. And I'm not going to go into all these details. You can look this up. But the main benefits here, these are accounts separate from an employer's 401k. You can save in the traditional IRA each year, and that you get a tax deduction for that if your income is below the limits that you see listed on the screen. For the Roth IRA, what's nice here, when you put money in, you don't get a deduction on your taxes right away, but all the growth that happens over the course of your lifetime, when you draw that out, it's all tax-free. These are basically like a golden ticket. You want to take advantage of this if you are under the income limits you see listed on your screen there. I know a lot of people who have maxed out their Roths for a long, long time, and those have been very helpful to help them meet their retirement goals. All right, the last vehicle we want to talk about here is what's called a traditional brokerage account. You can open this up on a Schwab, Fidelity, Vanguard, etc. This is not a retirement account, so you don't get any tax advantages here, but you have flexibility. If you need money as you're going along, you can go draw money out of this account without any penalties. And so this is a nice way. And what I say is first invest in your 401k. Once you've invested up to the limits allowed there, then you can turn your attention to a Roth or an IRA. And if you max those out, then you can go invest money in a brokerage account. Every person I have met over the years who has invested consistently over a long period of time, it has been very successful for them. But it's important that you don't make these 5 key investing mistakes that we're going to talk about today. The first one is something we covered a little bit earlier, which is just waiting to start. We went over that. I'm not going to spend more time on that. Start as soon as you can. The second mistake, and this is a biggie, don't give in to panic selling. Listen, it is not easy when the stock market is having a more significant decline to sit back and not feel like I need to get on and sell to stop the bleeding. In that case, I say turn off the news or don't look on the computer, because that's part of what happens with the stock market over long periods of time. The reason 8 to 10 to 12% rates of return are possible over long periods of time is because you have to accept the volatility. There's a lot of people who can't handle it. But if you can, the rewards are very impressive. Now, what I want to mention here is Warren Buffett has a quote: "Be fearful when others are greedy and greedy when others are fearful." That really is the truth. And by the way, I just talked about panic selling. It's equally the truth that if everybody loves the market, if it's at an all-time high, everyone's doing speculative things, you want to avoid that, because a lot of people do make that mistake and then pay a deep cost later on. Mistake number 3, market timing. All right, this is somebody trying to pick tops and bottoms in the markets. Listen, there's just a handful of people in the US that I have seen in my career that has over long periods of time been able to trade like that, actively trying to pick tops and bottoms over periods of times. For most people, this is a disaster waiting to happen. You don't want to time the market. You see the quote I have there: time in the market is more important than timing the market. Make sure you remember that. Mistake number 4, following the crowd. This is chasing hot stocks that everyone is talking about. And we have some examples of this. The first is internet stocks, the dot-com era. This was right when I started my career, 98, 99, 2000. The internet was new, and so there were a lot of companies coming public that people could invest in that didn't even have profits, and some didn't even have revenue. And yet, when they would come public, people would be in a race to try to buy the stock. And here's the thing, between 2000 and 2002, it was called the dot-com bubble. It burst, and on average, these stocks were down 80%, which if you lose 80%, you have to make a 400% gain just to get back to where you were. That's the dot-com era, was the first example. Then gold and silver. This was back in 2011. Gold had gone up 11 straight years, and there became a frenzy around gold and silver. A lot of people thought, hey, this is safe, this is secure. Gold then went on to drop over 45% in the years to come, and silver dropped over 60%. That shocked many investors who thought it was a sure thing, it was a safe thing. Then in 2021, GameStop and AMC, the term meme stocks, if any of you heard of that, these investments were going up every day in 2021, and a lot of people bought in near the top, and then these investments dropped over 90% to come. It was easy to see. We have some, and you can go back to our blogs where we were warning people, don't get involved here. It was hard to do, though, because a lot of people were hearing how much money others were making. And then the other last example there is also 2021, crypto and EV, electric vehicles. Any stock that had to do with the EV world and crypto were all going straight up. And same thing happened that in these other areas, 80, 90% declines. So The takeaway here is you do not want to get involved and just chase the hot stocks when you're hearing a lot of good news, because it normally ends very badly. Now, mistake number 5, not diversifying. Now, what I'm talking about here when I say not diversifying is putting all your money in one investment. You've heard the phrase, don't put all your eggs in one basket. That's what I'm talking about here. There are a lot of people I've encountered before who have all their money in 1 or 2 stocks, or all their money in one cryptocurrency. And that typically is a major, major mistake. Instead, if you diversify across the different types of investments that we talked about earlier, you are going to have success in the long run. Those are 5 mistakes that if you can avoid, like I said, over a long period of time, you are going to do very well investing. So what are the next steps? Well, the first thing is for you to calculate your monthly investment capacity. Basically, get down, do a budget, and see how much money can you start to save. And just a reminder, if you have not watched our budgeting video, that tells you the steps to do a great budget. Next, after that is going to be check to see if your employer offers a 401k matching. We talked about that is free money. Third step is to open an investment account, whether that be a 401k, an IRA, or a Roth IRA. And then lastly, once you have the account open, make your first investment. Well, that does it for our Investing Basics video. I hope you enjoyed it, and we will have our 3rd episode in this series in months to come. If you want to make sure you don't miss that, don't forget to like and to subscribe to our channel. Thanks for watching and take care.